Hi everyone. One of the things my clients ask me is how much salary should take versus how many dividends. Obviously that's quite a complicated area. If we're looking at tax planning for someone, there'll be other things we can think about in terms of pensions, dividends, salary, and some of the other things. What I wanted to cover here was a really simple guide to how you can sort of optimize your salary versus dividends from a really simple business point of view. So, if you're a normal business, you've not got too much going on, this is how you might do it, and this is how the different elements interact with one another. So I've done it with jugs, which seems odd, but bear with me. So in here, we've got the profit for the company. So hopefully you're a profitable company and you've made money during the year, represented by Ribena. Now the first step to do, we'll take the profit and we're going to pay ourselves some salary. So let's do that, we're going to do that. Some salary goes into here. So what level am I taking this to? Well, actually, the level of salary I'm going to pay is 8632, £8,632. And the reason I do that is because in order to qualify for pensions later in life, you need to have taxable earnings every year, okay? So yes, you can have dividends, but the government don't see that as taxable earnings, they see it as a return on investment. This here, salary, is taxable earnings. We've taken it up to 8632 because that's the NIC threshold. So that's the point where the government say, okay, you've earned enough to qualify for pension contributions later on in life, your state pension. But actually you don't have to pay any NIC. So you've reached the threshold, but you're right at the bottom, you don't pay anything. So that's why we say take some salary, but don't take too much, okay? The next port of call is to take the rest of our profit and we're going to transfer it into our retained earnings. So you'll see this in your balance sheet. Don't worry if that's too technical. Look at your balance sheet. If you see equity or retained earnings, this is what it is here. So we're going to take your profit and do that. But don't forget you have to pay some tax. So what I'm going to do here is take some out. This is 19% generally. There'll be some adjustments, but generally it's 19%. So the rest is going to go into your retained earnings. So just consider the way I've done that, because actually we started with salary and that was taken out, but that was taken out before we were taxed. Whatever we had left, we then transferred into retained earnings, and that's the point that it was taxed. That's important to remember. When you take salary, you don't get taxed on that. So what we've got left is some retained earnings. And in order to pay out a dividend, which is this pot here, we need to have something in our retained earnings pot. You notice before I transferred it across, there was nothing in there, so there's no way to pay any dividends. And this is the same if you make a loss. If you're constantly making losses, then you've got nothing left to put across to your retained earnings, so you won't be able to pay a dividend. So then this option won't be available to you. But if you do have some left over, then I recommend you use some reserves to pay some dividends. So let's do that. So you'll know, as I said before, tax has been taken out already. This is after tax, and then we're going to pay a dividend. So why do that? Okay, dividends, for the first 2K, it's tax-free. So if you can afford to do that, I'd recommend you took at least 2K dividends. The rest of it is generally taxed at 7.5% up to 50 grand. You'll get a personal allowance of 12.5 grand, so that's going to be tax-free, but anything after that is going to be taxed. With salary, that's taxed 20%, plus you've got NIC and you've got employers' NIC, etc. Whereas with dividends, it's only 7.5%. So there's some quick things I wanted to cover off for you. That's pretty much it. I just wanted to keep it really simple. Just want to explain how it happens. So first of all, you make profit, you take some salary out, £8,632. Obviously this varies, get advice from your accountant. This is just a really simple example. Then you take it, you pay your tax, which is this smaller jug here. The rest goes into retained earnings, okay? When you've got retained earnings, you're then capable of paying a dividend out. So without this, you can't pay a dividend. Then you pay a dividend, at least 2K. Anything above that, obviously you only pay tax at 7.5%. Even if you do go over the £50,000, then it's still a cheaper tax rate. Okay, so dividends are the most cost-effective way of taking money out of business at the moment. It might change, April when the government brings in a new budget, or if they decide to change it in the future. But at the moment, that's how it works. So I hope that's helped. I hope it's made it clearer for you. If not, just get in touch and I'll see if I can do something a little bit different. Thanks.